Alright, so when we are talking about capitalization versus expensing, what you really need to understand is the expenditure and the pattern of economic benefit arising out of that expenditure. So one thing is very clear, whenever an entity is incurring an expense, there must be an economic benefit associated with that expense. For example, if I have paid salaries to my administrative staff for this particular month, they will be working for me for this particular month only. In other words, the benefit of that expense is only periodic, only for that month. There won't be any further benefit out of that. That means if I need to make them work for the following months ahead, then I have to pay them salaries every month. So the nature of that expense will be periodic expense, and that expense will be charged off as and when incurred. So whether such expenditure should be capitalized or should it be expensed. When I say should it be expensed, means it should be charged off as an expense in the statement of profit or loss. So when the benefit of any expense, or you can say economic benefit of any expense, is not going to last beyond that accounting period, then that expenditure will be simply expensed out. In other words, charged off as an expense in the statement of profit or loss. Whereas if there is an expenditure, the benefit of which goes long, say multiple number of years, then such expenditure should be capitalized as an asset. When we say capitalization of an expenditure, means basically the nature of that expenditure is a capital expenditure, and precisely when you incur a capital expenditure, it creates an asset for you, and the whole amount of expense won't be charged off in the statement of profit or loss immediately. In fact, that whole amount will be capitalized and will be placed as an asset in the balance sheet. Later on, by way of depreciation or amortization, the entire cost of that asset which we have created by capitalization process now will be expensed out over the period of benefit. That means over the period, as long as that expenditure is rendering benefit to the entity, say 5 years, 10 years, 15 years, depending upon the lifespan of that economic benefits that we are going to derive out of that expenditure, the corresponding depreciation or amortization will be charged over such period. And how to charge depreciation or amortization, that we are going to separately discuss in detail when we come to the right topic relating to that. So right now, let us write some notes about capitalization versus expensing. So under this heading, I'm sure you have already written this heading, capitalization versus expensing. When a firm makes an expenditure, it can either capitalize the cost of an asset in the balance sheet or expense the cost in the income statement in the period it is incurred. As a general rule, an expenditure that is expected to provide a future economic benefit over multiple accounting periods is capitalized. However, if the future economic benefit is unlikely or highly uncertain, the expenditure is expensed in the period incurred. That means the period in which you have incurred the expense, you expense it out, or in other words, you can say you can charge it off as an expense in the statement of profit or loss or in your income statement. An expenditure that is capitalized is initially recorded as an asset in the balance sheet at cost. Now, obviously, when you are recording some asset in the balance sheet, initially, what should be the amount of that asset? So precisely it should be cost, and that cost represents the fair value. So cost, which is typically its fair value at the time of acquisition or at the time of construction, plus any cost necessary to prepare the asset for use. Now this is something important. See what happens. Suppose I have spent a huge amount on purchasing a machinery. Now machinery is not going to be just giving me benefit in the current period only. It is going to be a capital expenditure, because say the machine is going to last for next 10 years. Next 10 years I'll be using this machine. So the cost of the machine will be capitalized, but along with that all the initial incidental cost until the machine is ready for its intended use. So the supplier will be delivering the machinery to my premises by some transportation means. Delivery cost will be capitalized because without that the machine won't come to my premises. Then there will be cost incurred for installation of the machinery. Sometimes what happens, supplier charges to me a consolidated price of the machine inclusive of delivery and installation, and that happens, that has become a very usual practice. If you can remember, in the earlier classes I gave you examples that if there is a supplier who is supplying a television, the supplier will be collecting the price of the television and the supplier will be preparing that whole installation at the customer's place. That means the price of the television, the delivery charges, the installation and initial trial run, all is included in the price. The customer doesn't have to pay anything beyond that. However, in my example right now, I am the customer who has purchased a machinery. There will be delivery cost, there will be installation cost which is not included in the price of the machine, but that is one time initial cost and that will be capitalized along with the cost of the machine, that is along with the purchase price of the machine. So the fair value of the machine at the date of acquisition along with delivery and installation cost all will be capitalized. Suppose there will be one trial run to observe whether the machinery is operative or not. Until that trial run, all the expenditures will be capitalized. But once the machine is ready for its intended use, no further capitalization can be made until there is a significant increase in the capacity, which we can call as cost of improvement or kind of cost of replacement of parts, etc. Those matters we are going to discuss ahead when we deal with property, plant and equipment and other related concepts. So as of now, let me give you an opportunity to write down these notes and then I take you ahead. Alright friends, once you have completed writing this whole thing, let me explain to you something more. Now see, there can be certain capital expenditures which have indefinite life. For example, if there is any goodwill or if there is an asset like land. Now land cannot have limited life or finite life. Land is an asset which may have indefinite life. Goodwill, which may be arising by way of acquisition of a business or acquisition of a part of the business. In that case, if there is goodwill arising on that acquisition, that goodwill, you cannot say what will be the life of that goodwill. There cannot be a precise definite life of an asset like goodwill. So we all know that goodwill is an intangible asset with an infinite life. Though we are going to learn about intangible assets ahead, I am going to just give you brief about these matters right now. So other than assets which have indefinite life, all other assets, that means assets which will have definite life, will be either depreciated over a period or depleted over a period or amortized over the period. Three words I have used: depreciation, depletion or amortization. Now you should be very clear which word is associated with which kind of asset. For example, if I have a machinery will be subject to depreciation charge. But imagine that I have a mine, I have an iron mine or iron ore mine, and I am going to extract iron ore from that. What will happen? The value of that mine will be as long as it is having the resource of iron ore. Once I have completely extracted the entire quantity of iron ore, it is not going to be a regenerative resource, correct? It is a non-regenerative resource. It will deplete at a particular point. So depreciation arises because of wear and tear of something, correct? When you use an asset like machinery, it will wear and tear over its life. Whereas if there is a oil mine or ore mine from where I am extracting the minerals or ores or oil, I am depleting that resource, correct? That is where the term depletion suits over there. On the other side, with respect to intangible assets which do not have physical substance, correct, you cannot charge depreciation, because depreciation typically arises because of wear and tear. When there is an intangible asset, it doesn't have physical substance, so no question of wear and tear, but it has a finite life. It can be a copyright, it can be a patent right, it can be a franchisee right, any kind of right which has a definite lifespan. Then the initial cost incurred to acquire such right will be amortized over its life. So three components which may come into picture, all will have similar economic effects, because the initial cost which has been capitalized will be charged over the life of that particular asset by way of depreciation, depletion or amortization. So let us write those notes about this. So you may please pay attention on the screen. Except for land and intangible assets with indefinite lives such as acquisition goodwill, the cost is allocated to the income statement over the life of the assets as depreciation, which is applicable for tangible assets, depletion, which is applicable for natural resources, amortization expenses, which is applicable for intangible assets with finite lives. Depreciation, depletion and amortization reduce the carrying value, that is the net book value of the asset in the balance sheet, and the expense reduces the net income in the income statement. So please write up these couple of paragraphs and then I take you ahead. Alright friends, I am sure you have completed writing this much. Let us move ahead and continue writing further. Alternatively, if an expenditure is immediately expensed, current period profit before tax is reduced by the amount of the expenditure. Once an asset is capitalized, subsequent related expenditures that provide more future economic benefits, for example, rebuilding the asset, are also capitalized. Now let me just give a brief explanation over here. See, the subsequent cost with respect to an asset like a property, plant and equipment, say a machinery, can be classified into two categories: repair and maintenance kind of cost, or it could be a replacement kind of cost. For example, if there is a major part of an asset which needs replacement, then that replacement, the cost of replacement should be capitalized. Whereas if there is a regular repair and maintenance being carried out, it should be expensed as and when incurred. So you should be understanding one thing: when there is a cost to rebuild something, it is indication of enhancing the capacity. So basically the criteria that is used for capitalization of subsequent cost is the similar criteria with respect to the recognition criteria with respect to a property, plant and equipment, and that is why when we go to that specific topic later, we will be talking about that. So as of now, what I would want you people to understand is, keep in mind one thing, that the subsequent cost could be of repair and maintenance type, or could be replacement of substantial parts or major parts of that asset. So costs which are associated with replacement or rebuilding should be capitalized. Costs which are associated with repair maintenance type should be expensed out as and when incurred. Subsequent expenditures that merely sustain the usefulness of the asset are expensed when incurred, for example, regular maintenance. So please write up these paragraphs and then I take you ahead. Alright friends, let us move ahead once you have written this to the next point of our discussion, that is the financial effects of capitalization versus expensing. Now this is something very, very important. What could be the financial effects of process of capitalization or expensing out any expenditure? Now let us be very clear. First, understand one thing, that entity has incurred some expenditure. Say $30,000 is the amount of expenditure. Now first you question one thing, that is this expenditure a revenue expenditure or a capital expenditure? First you answer that criteria. based on the economic benefits that the expenditure is going to provide to the entity, you decide whether it is a capital expenditure or a revenue expenditure. If it is a capital expenditure, that $30,000 will be placed as an asset in the balance sheet, which will be depreciated or amortized over its useful life, over the period of economic benefits. However, if the economic benefit pertaining to that expenditure of $30,000 is only for the current period, the whole amount of expense will be charged off to the statement of profit and loss. Now, what will be the implication of identifying an expenditure as revenue or capital? If we capitalize an expenditure, the burden of that expenditure in the income statement for the current year doesn't go, correct? And the asset is placed in the balance sheet. So your asset, your equity, it increases in the current year. Now the later impact will be, because you have capitalized an expenditure, later on it will be charged off as an expense gradually over its life by way of depreciation. So as and when you are charging depreciation, then actually you are not incurring any expenditure out of your pocket every year, but the expenditure of $30,000 that you have spent earlier now is getting amortized over the life of the asset. So the future profit will get impacted adversely. The profit gets reduced because of charges of depreciation or amortization. So in the initial year, the asset and equity will increase, but in later years, the asset and equity will reduce. On the other side, suppose that $30,000 was considered as a revenue expenditure, it will place a heavy negative impact on the current year's income statement, because if you are charging $30,000 in the current income statement, that is current year's income statement, it will pull down your profit for the current year, but its later impact on profitability of years ahead isn't seen. So there may be various effects of capitalization or expensing an asset over various items in financial statement. There can be effect over assets, effect over equity, effect over profit of current period, effect over profit of later periods, effect over cash flow from operating activities, or even cash flows from investing activities. So there can be multiple effects that you will have to consider, and let us start discussing each of these one by one. So let me take you to some important points over here, and please start writing. Financial statement effects. Number one, we will observe effects on assets and equity. Capitalization will increase the assets and equity, whereas charging as expense will decrease the asset and equity. That is the impact we find on asset and equity. We have already talked about this. Effects on net income for the first year. Capitalization will increase the net income for the first year, whereas charging as expense will decrease the net income for the first year. So when we talk about the later years, the reverse effect will be observed, but that we will write later. First you finish writing this much. Alright friends, once we have completed writing this much, let us move ahead and continue writing further. Effects on net income for later years. I have already explained to you that capitalization will decrease the net income for later years, whereas charging as expense will increase the net income for later years, because the entire expense was charged off in the initial year itself. Effects on income variability. Now capitalization will decrease the income variability, whereas charging as expense will increase the income variability. Let me explain this point to you before you note it down. See, variability means the variation or fluctuation in the income. So suppose there is an expenditure of $30,000. Over next 5 years, maybe it is going to provide some benefit, and therefore we have capitalized that expenditure. Its life is going to be 5 years. So $30,000 spent now, 5 years is the period of benefit. So each year you charge certain portion of the cost as depreciation or amortization depending on the asset type. Now 1/5 of $30,000 will be what? $6,000 every year. So the charge goes 6,000, 6,000, 6,000, 6,000, 6,000. All 5 years, same charge allocated, or the pattern of charge could even match with the pattern of benefits. That is all relating to the matching concept. We are going to learn that in detail when we talk about depreciation and amortization. However, what is important right now for you to understand is the variability in income will not arise when you are putting a constant charge or a charge over a period. And imagine on the other side, you do the other thing, that is you expense out the entire 30,000 in the first period itself. Then first period expenditure is 30,000 and expenditure in year 2, 3, 4, 5 ahead, no expenditure booked. As a result, there will be very low profit in the first year and very high amount of profits in later years. So income will have variability when you go for expensing that item of expenditure. On the other side, when you capitalize, there will be a uniformity or less variation in the income for the entire period reported. So please write up these points and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead. Next couple of points, I don't have to explain it to you. Effects on ROA and ROE for the first year. ROA stands for return on assets. ROE stands for return on equity. These are very, very important ratios. We are going to learn these ratios in detail, but as of now, you just understand one thing. If there is increase in income for the first year, it is obvious that these ratios will also have an increase in the first year. And in the later years, if the income is going to decline, these ratios will also decline, because these ratios have a simple implication. Higher the income, higher will be the values of these ratios. Lower the income, lower will be the values of these ratios. So whatever effect you have seen in the income for current year and income for later year, same effects you will be finding over these ratios as well. So let us quickly write it down. Effects on ROA and ROE for the first year. Capitalization will increase the ROA and ROE for the first year, whereas charging as expense will decrease the ROA and ROE for the first year. Effects of this expensing or capitalization on ROA and ROE for later years, it will be just the opposite effect. So quickly write it up and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and continue writing further. Effects on debt ratio and debt to equity. Capitalization will decrease the debt ratio and debt to equity, whereas charging as expense will increase the debt ratio and debt to equity. The logic is very simple. When you are capitalizing, you know what you are doing? You are increasing the proportion of equity in your capital. So if you talk about the debt equity mix, when you capitalize any expenditure, you are just increasing your asset, and increase in your asset will have a corresponding effect on increase in your equity. So if equity increases, your debt to equity ratio or debt to total capital ratio, both ratios will be decreased if you are going with capitalization, and if you are going with charging off as expense, these ratios will definitely increase. Effects on cash from operation. Point is very logical and very simple. If you are charging something as an expense in the current period, it is basically an operating expense. So cash from operation will reduce in the first year. Later on, it will increase. Whereas if you capitalize an asset or capitalize an expenditure as an asset, what will be the impact? That amount will be not considered as expense in the statement of profit or loss, that is in your income statement, and as a result the cash from operation of the first year will be high. What happens to the cash from investing activity? Investing activity is basically where you are having investments. So when you are acquiring an asset, when you are incurring a capital expenditure, we call it as an investing activity. So cash from investing activity will have a different effect. Capitalization will decrease the CFI, that is cash from investing activity. Why capitalization will decrease? Because there will be a cash outflow towards investment, right? When you are acquiring an asset, say machinery, there is a cash outflow, and therefore when you are recording a capital expenditure as an asset, in the head investing activity within your cash flow statement, there will be a negative amount because there is an outflow which will reduce your cash flows from cash from investing activities. and if you charge it as an expense, there will be a reverse effect. The cash flows from investing activity will be more. So let us do one thing, let us quickly write up these points as well, and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue writing further. We will be now writing the summary of all the financial statements effect. I have explained everything to you. You just write down this summary. There is no explanation needed, but this summary can give you everything clear in one glance. So quickly write up this entire summary and then I take you ahead.